Okay, in this video we're going to be looking at how research and development contains positive externalities, so why there's a positive externality associated with research and development, as well as how the government uses research and development tax concessions to try and promote investment into research and development. So research and development is a positive externality in production, and the reason for that is that because it has benefits for third parties. So a lack of research and development is a market failure because firms fail to see the positive externalities in production. They don't invest enough in research and development because they don't consider the third-party benefits of that transaction. So they underinvest in research and development because they don't see the third-party benefits of that transaction. Without government intervention, there would be an under-allocation of resources to research and development because businesses don't want to take the risks, knowing that businesses can exploit or steal their ideas, so other businesses may come in and may take advantage of anything that they discover. There might be an under-allocation of resources to research and development. Governments have therefore developed things like intellectual property laws and patents so that businesses can't steal other benefits of research and development, so firms are more inclined to invest. The positive externality in production associated with research and development refers to the third-party benefits, and that might accrue to other businesses or just society in general. So, for example, if a manufacturing business conducts research and development into robotics, that may help to raise the productivity for that business. That can reduce their production costs and increase their profits, assuming the project works well. But that also may have benefits for other manufacturing industries because they might potentially be able to use that technology in their industry. It may have benefits for the military, and it may also just improve living standards more generally. So, for example, just through lower costs and increased productivity from using robots, that can flow on to benefits more generally for society. So there are third-party benefits associated with research and development in production, and therefore the government needs to internalise the positive externality by providing financial incentives like tax concessions, like grants, to increase research and development spending. So there's third-party benefits that aren't considered by the business in a free market because they're profit-motivated, self-interested. So the government steps in and tries to internalise these positive externalities by providing tax concessions and grants. These forms of assistance help to achieve a more socially optimal level of research and development. So it shifts the supply curve to the right. Because of the lower cost of production, it leads to increased development in these areas, and therefore it helps to achieve a more efficient allocation of resources and improve our living standards going forward. Recent statistics, research and development is the largest type of industry assistance through the budget. It's around 40% of all subsidies, grants and tax concessions. So it is a big part of industry assistance, providing research and development grants. The government is allowing businesses to reduce their tax liability at the moment through tax concessions if they invest in research and development. And the aim of that is to try and reduce the risks and costs involved in that. And we'll talk about how tax concessions work a little bit later. The aim of these tax initiatives is to try and boost the competitiveness and improve productivity by encouraging industries to conduct research and development that perhaps they wouldn't have done without that assistance. So the idea is that by investing in this research and development, they'll become more productive, they'll become more competitive, and that should have benefits in the long run for boosting our aggregate supply. So in terms of research and development tax incentives, you'll hear the word 45% tax offsets for business. Basically, it basically means the same thing as 150% tax deduction. So what that means is that businesses can legally write off as an expense 150% of the value of all research and development spending. So what that means in practical terms, if a business spends $200,000 on research and development, they can say to the tax office, no, we didn't spend $200,000, we spent $300,000, helping to reduce their taxable income. And therefore they have to end up paying less tax. So the idea is that they can inflate their expenditures and therefore artificially reduce their profits, and therefore they'll be able to pay less tax going forward. Businesses with revenue above $20 million get a slightly smaller tax concession, but basically they work similar to grants in that they leave businesses with more money to spend on other things because they have to pay less tax to the ATO. So you're showing an example of a business. So for example, let's say a business has $1 million profit, and we've already factored in that $1 million profit already factors in that they spent $300,000 on research and development. So their profit figure is after accounting for their research and development expense. They've got a profit of $1 million. Now with the tax concession, what they're able to do is they're able to say that $300,000, they can claim that as $450,000. They can claim an extra $150,000 as an expense, which leaves them with a taxable income of $850,000 instead of $1 million. So by claiming an extra $150,000 as an expense, they've reduced their profits by $150,000. So if the company tax rate was 30%, in the past they would have had to pay 30% of $1 million, which is $300,000. With the tax concession, their profits have been artificially reduced to $850,000. Now they're paying 30% of $850,000, which is $255,000. So in essence, they've saved $45,000 in tax with this tax concession. So that $300,000 they were spending on research and development, basically they will always get some of it back in tax, but with this tax concession they're getting an extra $45,000 back in tax, which is helping to encourage them to conduct that research and development. So the tax concession has therefore effectively lowered the cost of research and development by $45,000, which is basically works the same as just giving a business a $45,000 grant to invest the same amount to invest $300,000 in research and development. So in the 2017-18 budget, we'll talk about these a little bit more in class.